Welcome to Talk Tickers, your direct line into the financial heartbeat of major companies. Today, we're really diving into the second quarter 2025 earnings call for PNC Financial Services Group.
That's right.
Our mission here is to, cut through the noise, see how PNC is charting its own path. They seem really focused on organic growth, disciplined execution. It's kind of a shifting landscape out there.
Definitely.
So we'll uncover the key numbers, management insights, those strategic plays shaping their future, give you the shortcut to, well, being well-informed.
Exactly. We'll break down the performance, their capital position, the guidance, get you that crisp, clear picture of what really matters from this release and maybe why PNC, stands out a bit.
Okay, let's kick things off with the top line numbers, the ones that caught our eye first. PNC reported net income of $1.6 billion.
Right, which works out to $3.85 per diluted share.
Pretty solid.
Yeah, but what's really impressive here isn't just the number itself, but how they got there. You saw a solid 4% increase in total revenue, and that was combined with a stable non-interest expenses. So that led to what we call positive operating leverage, about 4%.
Meaning revenue grew faster than costs.
Precisely. And a significant 10% jump in PPNR. That's pre-provision net revenue.
Right. The core profitability metric before loan loss provisions.
Exactly. It shows the bank's underlying earnings power.
Okay, digging a bit deeper then into the balance sheet. Loans grew 2% this quarter.
They did. And actually, that's the highest new production PNC has seen in 10 quarters.
Wow, okay.
Yeah, with strong commercial loan growth really leading the charge there.
And what about capital? How are they looking on that front?
Very healthy. Their estimated CET1 ratio stood at 10.5%.
CET1, the core equity buffer.
Right, the strongest form of capital. And maybe even more telling was their start to trough capital depletion in the recent stress tests. Just 80 basis points.
80 basis points. So less than 1% erosion in a severe downturn scenario.
Yeah, and that was the lowest in their peer group. It really signals, resilience.
That's a strong signal.
Definitely. They also boosted their common dividend 10 cents more, a 6% increase, up to $1.70 per share.
Okay.
And returned about $1 billion total to shareholders through dividends and also share repurchases.
So that loan growth, a significant bright spot, you said.
Yeah.
Especially that 10-quarter high for new production. What was the mix there? Was it mostly existing clients borrowing more, or was PNC bringing in genuinely new business?
It was definitely a combination. You saw an uptick in utilization from existing clients, partly maybe influenced by some tariff considerations, but critically also really robust new production.
Okay.
And this new production, it's not just random, it's largely coming from their targeted growth markets. It's kind of the result of years of strategic effort paying off.
Right.
Their commercial and institutional banking C&IB, for example, saw a strong 4% increase.
And deposits, did they keep pace with the loan demand? And what's the story on deposit costs? That's always crucial.
Yeah, good question. Deposit balances increased by $2 billion, averaging $423 billion for the quarter. And those non-interest-bearing balances, the core checking accounts, they were up by $1 billion, still holding steady at about 22% of total deposits.
Which is a good number.
It is. And the rate they paid on interest-bearing deposits stayed essentially flat, 2.24%. Management did mention, though, that while they have one of the lowest cost deposit bases, they are actively discussing being maybe a bit more competitive on pricing in those newer high-growth markets.
To grab share faster.
Exactly, to accelerate share gains. Though they were clear, their primary focus is still growing those DDA households. Demand deposit accounts, those sticky, low-cost accounts are just gold for a bank.
Yeah, that focus makes sense for managing costs long term. So, okay, impressive loan growth, disciplined deposit strategy. How did it all flow through to the bottom line? Let's look at the income statement. How are they keeping up that positive operating leverage?
Well, a key driver there is their continuous improvement program. It's a strategic thing aiming to cut costs by $350 million in 2025, and they're squarely on track to hit that target. What's interesting is it's not just about cutting costs randomly. It actually funds significant ongoing business and technology investment.
Right, so they reinvest the savings.
Exactly. Allows them to reinvest in growth.
You mentioned tech investments. How specifically is something like AI playing into those efficiency goals right now? And what's the bigger picture, the vision there?
AI is already delivering, concrete cost savings. They're using it for things like fraud detection, much more efficient.
Sure.
And document sorting, helping employees be more productive, building data lakes for better model accuracy across the bank.
So it's not just hype.
No, not for them. They see it as an acceleration of automation efforts they've had for a long time. And looking ahead, management seems really focused on how AI might fundamentally change, the whole delivery of financial services,
Right.
like computer-generated advice through mobile platforms, basically getting highly personalized financial guidance right there in your pocket.
Interesting. A potential game changer down the road. Okay, let's talk revenue streams again. Net interest income was up, which is good,
Right.
but non-interest income guidance for the full year got nudged down just a bit. What's the story there?
Yeah, so net interest income, the profit from lending increased 2%.
Yeah.
That was driven by higher loan balances, fixed rate assets repricing higher, and even just an extra day in the quarter.
Right.
That pushed their net interest margin, the NM, up 2 basis points to 2.8%.
2 basis points, 0.02%.
Yeah, yeah. Now, while their capital markets and asset management businesses are doing okay, maybe even a bit better than expected,
Uh-huh.
the slight downward nudge on full-year non-interest income guidance from 5% growth down to 4-5% range reflects a few things, just sort of heightened economic uncertainty.
General caution.
Yeah,
Yeah.
exactly. Some soft spots they saw in corporate spending back in Q1, and also some headwinds in private equity valuations. It kind of mirrors the broader economic mood, really.
Got it. Okay, let's pivot to credit quality. Always crucial for a bank. The headline numbers look pretty strong,
They do.
but are there any, nuances or areas management flagged beyond that expected increase in Q3 charge-offs you mentioned?
Right, you always got to look beneath the surface. But overall, credit quality does remain robust. They actually saw improvements across non-performing loans, delinquencies, and charge-offs in Q2.
Okay.
Non-performing loans were down 8%, which is good. And the net charge-off ratio was really low, just 25 basis points.
Very low.
Yeah. That expected increase in Q3 net charge-offs to the $275-300 million range.
Ah.
Management was clear that's primarily due to a known pipeline. It's commercial real estate office exposures they've already fully reserved for.
So stuff they knew was coming and have set money aside for.
Exactly. It's anticipated to flow through, but importantly, it's not seen as a sign of broad, widespread credit deterioration. It seems like a contained issue they've planned for.
Okay, that context is important. And on capital, they seem, as you said, remarkably well positioned, especially after those stress test results. What's the sort of broader vibe around their capital levels?
Yeah.
Especially with, all the ongoing regulatory talk and how rating agencies are looking at banks these days.
Yeah, it's a big topic. They finished the quarter with that strong 10.5% estimated CET1 ratio, or 9.4% if you include AOCI accumulated other comprehensive income.
Right.
Either way, well above their regulatory minimum of 7% from the stress tests. Management basically said they feel their current levels are appropriate, especially since the new tougher capital rules aren't even finalized yet.
Makes sense.
But here's a really interesting point they made. They highlighted how rating agency requirements are actually the binding constraint for the industry right now.
Meaning the rating agencies are demanding more capital than the regulators currently are.
Essentially, yes. Pushing banks to hold more capital than the current regulatory minimums strictly require. It's a major discussion point across the industry. Banks are effectively being held to a higher standard by the market and rating agencies.
Interesting dynamic. Okay, PNC has consistently talked about its national growth strategy, the importance of scale. Are they still mostly focused on doing that organically? Or is M&A, mergers and acquisitions back on the table, especially when you see some competitors making moves?
They really doubled down on the organic growth message, strongly reiterated their commitment. The line was basically bigger is better, and they plan to get there by, expanding their client base and just growing the business they have.
Okay.
They seem very confident they're gaining significant market share in their newer markets, calling it an enduring source or permanent driver of Lloyd growth, not just a temporary blip.
Right.
And they were pretty explicit, said it's extremely unlikely they'd pursue inorganic growth, like buying another bank, especially in the retail credit space.
Like that.
Their reasoning was that acquisitions there often involve, quote, broken businesses, and they don't see themselves as experts at fixing those kinds of problems.
So stick to what they know and build it themselves.
Pretty much. And that $1.5 billion branch investment, over 200 new branches planned in those expansion markets, plus new online and mobile banking rollouts, it all points to that organic, build-it-from-the-ground-up retail strategy.
Very clear direction, then, quite distinct from some others. Okay, thinking macro now. What's PNC's view on the economy and interest rates, and how does that feed into their full-year guidance?
They expect continued, though, modest economic growth in the second half of 2025. They're projecting real GDP growth around 1.5% for the full year.
Okay, moderate growth.
Yeah, they do see unemployment ticking up a bit, maybe to around 4.5% over the next 12 months. And importantly, for interest rates, they only foresee the Fed cutting rates once in 2025.
Just one cut.
Just one cut, 25 basis points, likely in December. That's their base case. And this sort of cautious but still optimistic outlook underpins their full-year guidance, which, interestingly, they actually raised for average loans and net interest income.
So despite maybe a cautious rate outlook, they're confident in their own momentum.
Seems that way, yeah. Reflects confidence in what they're building organically.
Okay, finally, let's touch on some of those emerging topics. Things like stablecoins, fintech data access fees. How is PNC positioning itself with these potential disruptors and opportunities?
They seem to be actively engaging, not shying away. They mentioned plans to announce services for crypto companies using PNC's payment tech.
Interesting.
Also enabling their own clients to use crypto things like wallets and trading in the near term. And they expect to be part of whatever industry-led stablecoin solution emerges.
So embracing it rather than fighting it.
Seems like it. They don't apparently see stablecoins as massively changing the whole domestic payment system or like draining deposits overnight. They view them more as just another payment tool.
Something to integrate.
Right. Integrate into their platform, potentially creating new revenue streams in payments and treasury management. And on those fintech data access fees, they're in discussions and sounded supportive of peers trying to charge for the cost of securing and providing that data, basically acknowledging there's a cost and value there.
Okay, so quite plugged into the evolving landscape. We've covered a lot today. Robust loan growth, AI investments, that disciplined capital strategy, even crypto. How should an investor pull all this together? What's the core story PNC is telling?
Yeah, I think PNC's Q2 really underscores this theme of disciplined execution and strategic foresight. Their ability to drive that organic loan and customer growth, particularly in the expansion markets, really does stand out. They see it as an enduring source of momentum, separate from just broader industry trends.
Not just riding a wave.
Exactly. It feels like they're actively building market share from the ground up. You couple that with the strong capital management, the clear expense discipline, that pragmatic but forward-looking approach to tech like AI and crypto, it paints a picture of building a solid foundation for sustained performance. They're clearly not chasing M&A deals just for size. They seem much more focused on maximizing their existing franchise and really investing in those high-return organic initiatives. For an investor, it suggests a management team that's both patient and strategically pretty decisive.
That disciplined approach really comes through.
Yeah.
Okay, with that context, let's shift gears slightly for our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea based on everything we just heard. And remember, folks, purely for intellectual amusement, not a recommendation.
Absolutely. All right, looking at PNC's performance, their strategy talk, my outrageous but plausible trade idea is this. Boo long PNC paired with a short position in a regional bank that doesn't have such a clear, self-funded organic growth story.
Okay, long PNC, short, a less focused regional. What's the rationale?
Well, the thinking is this. PNC management explicitly called their organic growth in new markets an enduring, permanent driver of share gains, not just temporary utilization bumps.
Right.
They're putting serious money behind it, $1.5 billion in new branches, pushing hard on digital and AI. These are real capital-intensive bets on future share and efficiency.
Concrete actions.
Exactly. And they're doing this while having one of the best stress test results, capital-wise, in their peer group, and deliberately avoiding those, quote, broken retail M&A deals. It signals a very disciplined, long-term value creation plan.
Okay.
Now, contrast that with many regional banks. They might be facing bigger headwinds from squeezed margins, maybe more lingering commercial real estate worries, and often they just lack the scale or maybe the willingness to make similar big bets on organic growth.
So the trade is betting on PNC's self-help story versus others who might be more reliant on the macro environment.
Precisely. The long PNC leg is a bet on superior, sustainable, self-funded organic growth and smart capital use. The short leg hedges against or profits from a peer that maybe can't generate that same kind of internal momentum. It's less about just guessing interest rates and more about backing a company actively building its future market share, brick by brick or maybe click by click these days.
An interesting play definitely focuses on execution differences.
Yeah.
Okay, that wraps up our deep dive into PNC's second quarter. It certainly seems clear they're executing a very focused strategy, organic growth, efficiency, really trying to control their own destiny in a dynamic environment.
Indeed. That commitment to building out the franchise organically, plus the disciplined capital approach, the tech integration, it does paint a compelling picture. What really stood out to you from the call?
For me, it's that contrast between their organic focus and actively avoiding certain M&A. It shows real strategic clarity. But as always, this analysis is just for informational purposes. It is definitely not financial advice. We absolutely encourage you to do your own research and due diligence. Thank you for tuning in to Talk Tickers.